Okay, welcome back to video number 3 on GDP, our selection of videos, instructional videos on national income accounting, gross domestic product. So gross domestic product is what? It's a measure of a nation's economic activity, how much economic production takes place within a country in a year. Gross domestic product is a monetary measure of all final goods and services produced within the domestic borders of a country. So let's compare some countries. Let's see which countries rank where when we talk about economic output. Well, these are 2007 numbers. In 2007, the United States was the world leader in economic output by a large amount. The United States was the world's largest economy, producing just over $13 trillion worth of goods and services. Coming in second in 2007 at just about $4.5 trillion was Japan. Then third was Germany, and followed by China. Right now, let's talk about Germany, UK, France, Italy, and Spain. All of those countries are EU countries. So we could actually rank the United States of Europe, or better known as the European Union, against the United States of America. So the European Union ranks just about on par with the United States if we collectively took that economic entity as one unit. We'll look at that data on another slide. But let's remember the order here: United States, Japan, Germany, China, and then let's skip ahead to 2011 data. So if we skip ahead a few years, 4 years, now look what's happened. United States is still ranked number 1, right? But look who has jumped up from 4th to 2nd is China, right? And the United States' position of dominance is starting to dwindle because China is roughly half of the U.S. production by 2011, right? Japan still ranks 3rd, Germany 4th. Let's look now at 2011, but under a different microscope, so to speak. So here you can see that there's a blue line measuring GDP for 2011 for each country, and then we'll call that a pink line, right? So if we look at the ledger down bottom, it says GDP adjusted for PPP. That's purchasing power parity. And the pinkish line, that's the one unadjusted for purchasing power parity. Now, this is not a finance class, but economists like this tool of purchasing power parity. Exchange rates are something we're going to investigate at another time when we talk about international trade. But let's just do a brief explanation of exchange rates and talk about what is meant by purchasing power parity and why economists feel as if using purchasing power parity is a much more, we should say, fair assessment of comparison when we look at economic output across a few countries. So, you know that if you wanted to buy goods and services in Europe, you couldn't spend dollars, you would have to spend euros, which means that you would have to exchange your dollars for euros. Okay? Now, in theory, if exchange rates are accurate or exchange rates are efficient, as economists like to say, if we think about a market basket of, say, 200 goods and services that's selling in the United States, and we compare it to the exact same market basket of goods and services selling in Europe. Now, what would be included in that market basket? Fruits and vegetables, and maybe compact discs, or maybe MP3s now. How much you pay? Maybe streaming service, right? How much it costs to heat your house? All of these things. Now, even this becomes tricky because we understand that the cost of making certain goods and services available is going to vary from country to country. But that's why we take a large basket, a market basket. We don't just compare the price of one good or service, although The Economist offers what's called the Big Mac Index every year to go about doing this same exercise. In theory, the way it should work is that if you take US dollars and you exchange them for euros, right, after taking into account the exchange rate, your money should buy the same amount of goods and services in either place after exchanging currencies. But economists find out that that's not always the case. Sometimes currencies are undervalued or overvalued when you take into consideration how much you can actually purchase with the currency after exchange rate has been taken into consideration. So we're not going to use numbers here because that would just be a little bit too much for our intro to macro. But in essence, what purchasing power parity is doing, it's equalizing out that exchange rate differential. So it says, okay, if we take purchasing power parity into consideration, your money would buy the same basket of goods and services in any country around the world. Okay, but if you look at this, say the United States is still number one, China is number two. But look at the difference when we say, okay, the United States produced $15 trillion worth of economic outputs in 2011. China produced 7.7, but if we take purchasing power parity into consideration, China is not really that far behind the United States anymore, only at $11.3 trillion worth of goods and services. Now it's interesting though, Japan actually loses ground when you take into consideration purchasing power parity. So that's why economists generally appreciate the value of using purchasing power parity as a tool to try to equalize, shall we speak, exchange rate differences and to accurately measure quantity of output in each country. Let's see how U.S. GDP has changed over the century. So here we have the mix of output in 1990 versus the mix of output in 2000. So two big things should jump out at you looking at these two different pie charts. I'll let you take 1 second to think about it. And let's give you the answer. So look at farming in 1900, 37% of U.S. GDP. So we were an agrarian country, right? We were an agricultural nation. In 2000, farming fell to, wow, only 2% of our economic outputs, right? That's kind of crazy to think about what a difference that made, right? Now, the other thing that jumps out at you is, so farming fell from 37% in 1990 to a mere 2% in 2000. Look at services. Services jumped, though, from only 22% of the economy in 1900 to a whopping 54% of the economy in the year 2000. And as I said earlier, we are a service-based economy. A rather big jump in government spending, 8%, right? 8%, but in terms of that percentage change, 8 out of 10, it's an 80% increase in government as a percentage of economic output from 1900 to 2000. And that's mostly because of the Keynesian revolution, which we will get into later. All right. Now, the one that doesn't look like a big change but has had a large impact on the average everyday person's life here in the United States, especially when you talk about blue-collar workers. Manufacturing was 22% of the economic mix in 1900, so 22% of GDP. In the year 2000, manufacturing only fell to 20%. Now, you keep hearing people say, oh, we've lost our manufacturing base. Well, that's kind of insane. You think, it's 20% of a much larger number, right? It's 20% of a much larger number. But employment in manufacturing is down mostly because of mechanization. In other words, there is still a large amount of manufacturing that takes place here in the United States. 1/5 of our economic outputs, of our economic production. But a lot of that now is done with machines. How about this little statistic about the decline in farming? In 1900, nearly 4 out of 10 people worked at a farm in agriculture, and now it's less than 2% of the workforce. So now that we have introduced a basic comparison of the United States with some other countries and how U.S. GDP, U.S. economic output ranks against other nations, and we did a brief examination of GDP or economic output over time between the 1900s and 2000s, basically how the compensation and distribution of output changed over that 100-year period. Let's revisit this idea of two approaches to GDP. So remember, GDP is what? It's a monetary measure of all goods and services produced within the domestic borders of the United States in a given year. So GDP is a measure of how much economic activity takes place in a year's time. So we went over this expenditures approach in detail. C plus I plus G plus X. We can add up all the money that was spent on final goods and services as one means or mechanism to calculate GDP, to calculate economic output. We could also, instead of adding up all the money that's spent on final goods and services, the expenditures approach, we could add up the income generated from producing those same exact goods and services. So think of your cable bill. Your cable bill comes in the mail. You pay the cable bill. It was $150. From your standpoint, it was $150 worth of expenditures. From your cable company's standpoint, it's $150 worth of income, right? Revenue, income for that corporation, whether it be Fios or Verizon, I should say, or Comcast, right? So we can just as easily add up all the income that is generated from producing those same goods and services. Now remember, we said the expenditures approach is far more important because we need this understanding of the expenditures approach to also introduce and explain topics such as aggregate supply and aggregate demand and fiscal and monetary policy. But the income approach also has value. When we lay out the numbers here for the income approach, the one that's going to jump out at you is compensation to employees, or compensation of employees. So the salary and fringe benefits, the wages that labor receives, is by far the highest number when you break down the income approach. We will look at the actual numbers on the next slide. Rents, interest, and proprietors' income, they don't even come close to the amount of money generated by just good old-fashioned people working every day and receiving a paycheck and their fringe benefits. So let's look at this, and we will also throw in there corporate profits. I want you to look closely at compensation to employees and corporate profits when we compare 2007 versus 2009 and the economic data from those two time periods. So what was going on in 2007? This is right before the recession started. We call it the Great Recession, probably the worst economic downturn since the Great Depression. So 2007 was actually a positive year when you talk about in comparison to 2006. But the recession definitely started in very, very late 2007. The economic downturn began. Now, why was the economy catapulted into recession in this time period, 2007, 2008, 2009? It was that housing and financial crisis that not only plagued the U.S. economy, but also wreaked havoc on the entire global financial and economic system. So in 2007, total GDP for the United States, you can look down bottom, was $13,841 billion. As we said, we can either add up all the money that's spent on final goods and services, the left-hand side of this page, C, I, G, X, or the income generated in producing those same goods and services. And with a little bit of a statistical adjustment, with that statistical adjustment on the right-hand side, we will come out to the same number. And that should make sense because we're calculating the same principle, GDP, economic output. Real quick comment here. So in 2007, the United States had a trade deficit of $708 billion. Now, if you look on the right-hand side, like I said, of the $13.8 trillion worth of economic activity which took place in the good old US of A in that year, the lion's share went to compensation, went to wages and fringe benefits, 78.74 out of 13,841. Now, look at corporate profits and compensation. Let's remember these numbers. So 78.74 and 16.27. Okay, you remember 78.74 and I'll remember 16.27. Just kidding. I'll remember both of them. So in 2007, people going to work each day, when you count up all the wages they earned and you throw in their fringe benefits, that came to a total compensation of 78.74. And corporate profits were 16.27. Now remember, the economic downturn started at the very end of this year in 2007. Definitely started things started to get worse in 2008 and continued to get worse in 2009. So if you remember 78, 74, and 1627, now let's look at 2009. 78, 74 has fallen to 77.92, right? And 1627 has fallen to 1309. So both compensation to employees, to people working, and corporate profits fell over this time period. And this should make sense because less economic activity took place during the recession, and therefore real GDP, right, GDP adjusted for changes in the price level, actually declined. We were in a recession, a pretty severe recession. Also notice on the left-hand side how much the trade deficit narrowed, right? The trade deficit was pushing $800 billion in 2007 and was less than $400 billion in 2009. That's typical during a recession. Usually the trade deficit narrows because Americans have less money to spend on goods and services and spend far less on fancy schmancy imports, some big ticket items from some European countries and other countries. But notice that the total number here is still larger than the 2007 number. So 2009 GDP works out to be 14,256. But in comparison to 2008, it was lower than 2008. All right, let's go on, move on, and talk about some other national income accounts that are important to our study of macroeconomics. So now that we've investigated the numbers and said, okay, we can either add up all the money that's spent on final goods and services, the expenditures approach, or the income generated from producing those same goods and services, there are a few other ideas here that are important to us, and this is why we actually need the income approach. Net domestic product. So we have gross domestic products, the total amount of economic activity which takes place. Net domestic product. Remember when we studied gross business investment, we said during the year machines are used up, they're worn out, right? Consumption of fixed capital or depreciation. Those two terms mean the same thing. Consumption of fixed capital or depreciation simply is a measure of how much in total money value have machines worn out, right? How much is capital worn out over the year? So what net domestic product does is it takes GDP, gross domestic product, minus depreciation or minus of consumption of fixed capital, and it comes up with a number. Now, what does this number tell us? So it's easy to calculate net domestic product. Take total economic activity, GDP, minus the amount of depreciation, how many machines and such were worn out over the year. So it tells us how much the United States can produce and consume without impairing our ability to produce in the future. I will say that one more time. Net domestic product is a measure of how much the United States can produce and consume without impairing our ability to produce in the future. Now, the book goes into a fancy schmancy, very detailed explanation of and convoluted sort of calculation of national income. I think it's easier to explain to students national income is simply income generated from American-owned resources, whether that generation of income takes place either here or in other countries. So think of some of the big U.S. conglomerates such as McDonald's or Nike or Caterpillar, right? Some big pharmaceutical companies, Microsoft. They have production facilities here in the United States and production facilities in other countries. If we add up all the income generated by American-owned resources, whether at home or abroad, this would help us calculate national income. Now, personal income. This is going to sound a little bit convoluted as well, but sort of the numbers on the next page will help you understand. Some income is earned but not received because at the end of the day you have to pay taxes on it. Some income is also received but not earned. So personal income includes both of those. The transfer payment income that some people receive plus all income that was earned from working, right? Personal income. That's what personal income is. The one that's most important is disposable income. So disposable income is how much money we all have left to spend when it's all said and done. So we're going to look and say, okay, if the economy produced $14 trillion worth of goods and services, how much money flowed back into the hands of households? disposable income, money that can be spent on next year's economic activity. We will do an entire chapter on this idea of macroeconomic relationships, but disposable income equals consumption of savings. What does this mean? DI equals C plus X. Disposable income is after tax income. So after we've paid taxes, you can only do two things with your money. You can spend it or you can save it. So disposable income equals consumption plus savings. Here are the actual numbers from 2007. So in 2007, the United States produced $13.8 trillion worth of GDP, right? To be exact, $13,841 billion worth of goods and services. Consumption of fixed capital or depreciation. In other words, if we measure how much machines were used up, were worn out to produce that economic activity, that was 1687. So if we take 13,841 minus 1687, that gives us a net domestic product of 12,154 billion, meaning the United States was able to produce and consume 12,154 billion without impairing our ability to produce in the future. All right, national income, which I already explained as the amount of income generated by American-owned resources, whether home or abroad, worked out to be $12,221 billion. You could also think like, okay, well, 13.8 trillion, 12.2 trillion, that's pretty close. In other words, national income isn't that different a number than GDP. Okay, personal income. So if you look, how do we get from national income to personal income, right? Well, get some taxes, some Social Security contributions, corporate income taxes, undistributed corporate profits. All those are taken out. We throw back in transfer payments, so unemployment benefits and welfare checks, Social Security benefits, right? And we come to personal income. Now, of that personal income, people still have to pay personal taxes, and this gets us to our grand finale, disposable income. So, disposable income, again, is an important number because it tells us how much money Americans have left over from economic production in that year to spend on future economic production. So 2007, disposable income was 10,177 billion. So if you take 10,177 over 13,841, right, that will give you what percentage of disposable income was actually generated by the economic activity within the United States. Disposable income is most closely watched because at the end of the day, it is disposable income which generates future economic activity. So disposable income is most closely watched by the Bureau of Labor and Statistics and the Bureau of Economic Analysis because it's really a measure of how healthy spending can be going forward. Right? Now, one criticism of the U.S. economy has been, although total disposable income has been rising, when we look at the distribution of disposable income, it's actually getting far less equitable. All right, so 10,177 over 13,841 works out to be 73.5%. So of the $13.84 trillion worth of economic activity which takes place in 2007, right, 73% of it, or 73.5%, was left over as disposable income. So that's pretty strong. But it seems as if the United States, and this has been going on for 2 or 3 decades now, this is not a new phenomena, those at the top, those who are innovative, creative, or in a position of authority or ownership tend to be doing really well, while the middle class has been struggling a bit. It's a very interesting normative economic debate on why this is taking place. Now, if we take these numbers, simply compare them to this slide, provides the same economic ideas as the previous slide. GDP, NDP, national income, personal income, disposable income. The only thing I really want to point out is that in comparison to 2007, disposable income grew meagerly between 2007 and 2009. And again, this is because of the economic downturn, the recession of the Great Recession, as we call it, the financial and housing bust which occurred over this time. Okay, economics fans, let's look at some real life econ data about our production as a nation from 2005 through 2013. So this is GDP data over the course of that time frame. Let's just look at the some simple ideas to begin. If we look at the total numbers from 2005 to 2013, we recognize what we call the trend, right? Is that upwards and onwards, good soldiers. In general, the economy grows at roughly just under 3% in the long run. So in 2005, real GDP was just over 13 trillion, and by 2013, GDP was approaching 17 trillion, which is what we would expect. However, remember, we go through business cycles. In other words, we go through those 4 phases of economic expansion, a peak, an economic downturn called a recession, and then the bottoming out called the trough. Notice that between 2008 and 2009, real GDP actually declined. In other words, economic output was 14,720 billion in 2008, and it was less in 2009 because of the Great Recession, the financial and housing collapse which caused the Great Recession. Let's look at those 2 years more closely. Let's look at gross private investment for 2008 and 2009 respectively. Notice that investment spending dropped significantly or substantially during the recession, from 2.42 trillion in 2008 to 1.878 trillion in 2009. This is what we would expect. Businesses react primarily based on profit motives, and incentives matter, a basic economic idea we covered early in the term. When there are few projects which are going to return any positive profit for businesses, businesses will cut spending on machines and equipment and tools in factories and refurbishing old equipment. Likewise, if a business has, say, 100 machines and only 60 of them are being used, why would they refurbish or replace any of them when the demand for their product or their service is meager? So investment spending is quite important because it drives business cycles, and you can notice how far down it went in that time frame of the recession. Let's also skip down to government expenditures. Notice that government expenditures actually increased between 2008 and 2009, and actually continued to increase through 2010 and such, because what we call fiscal expansionary policy. In other words, when the private sector, that is consumption expenditures and gross business investment, when they fall during a recession, according to John Maynard Keynes, it makes sense for our government to increase expenditures on things like roads and schools and bridges and such, social capital, to fill in that gap of economic decline. Let's look at the net export picture over this time frame. Notice how much the trade gap has narrowed. In 2005, we had a $715 billion trade deficit. You can see that is negative 715 under the first column, matching up 2005 and net exports. Slide all the way over to 2013, and you're like, wow, man, you know, our trade deficit was only $493 billion in 2013. Now, last year, which was 2016, the trade deficit increased back to $550 billion, but still far shy of the $715 billion trade deficit we had in 2005. This is happening primarily for one reason, and it is the domestic energy boom taking place in the United States. We are awash with natural gas and oil because of directional drilling and fracking, which means we're importing far less of those fossil fuels. One more idea related to the net export piece of the puzzle. Notice how small the trade deficit was in 2009, only $392 billion. This is principally because the economic downturn reduces spending on goods and services here at home domestically, but a lot of imports tend to be high-ticket priced items which people end up foregoing, not purchasing because they're not doing quite as well. So it's always good to look at some real world data to get a good picture of what's actually taking place in the world, not just to study some economic theory.